Kraken Pro is the powerful crypto platform for experienced traders who demand the best. With advanced charts, real-time market analytics, and lightning-fast trade execution, Kraken Pro empowers you to trade your way. Customize your setup and make every pixel count by rearranging and stacking trading modules in a way that makes sense to you. On Kraken Pro, you have the freedom to put your favorite market analytics and execution tools exactly where you need them. And whether you're a seasoned pro or just starting out, Kraken Pro has everything you need to navigate over 210 plus assets with confidence. Join the thousands of seasoned traders who trust Kraken Pro. Visit realvision.com/Kraken Pro. Are risk assets the place to be? Hi, everyone. Welcome to the Real Vision Daily Briefing. I'm Maggie Lake. With me today is Michael Howell, the CEO of CrossBorder Capital. Hi, Michael. It's great to have you back on the Daily Briefing.
Hi, Maggie. Great to be here, too.
So we already have some excited people in our chat. You are a favorite among our members because you are an expert at tracking global liquidity, which we're, I think, really all starting to understand what an impact that has on all different types of global markets and assets. So let's kick off. We're going to drill down, but let's kick off very big picture and talk to me about what you see happening with global liquidity right now.
Okay, sure. Well, I think you've got to take three perspectives. Let's think about the short term, the medium term, and the long term. I think to get the long term out of the way, first of all, I mean, the outlook is pretty upbeat, mainly because we're in a situation where the fiscal arithmetic of governments, both in the US and in the West in general, just don't add up anymore. The only way that they can finance these mandatory spending promises, like Medicare, Social Security, is to basically turn back to the Federal Reserve or the banks and effectively print money. We're in a world of a regime change. I mean, just look at what happened during the COVID crisis. What was the response there? More spending, but it didn't come through higher taxes. It wasn't paid for that way. It was paid for by bond issuance or indirectly by monetization. And that's the way forward. So in the longer term, we're seeing a situation where monetary inflation is likely to accelerate. Now, I draw the distinction and a clear distinction between monetary inflation and high street inflation. They're not necessarily the same thing. Monetary inflation probably leads high street inflation, but we're in a regime where fundamentally what you've got is more monetary inflation, in other words, devaluation of paper monies. And what you want is monetary hedges against that. So that's the long term. The short term is more challenging, and I'll come on to the medium term after that. But in terms of the short term, what we've got is probably an air pocket in liquidity, notably in the US, possibly more globally as well, depending on how the dollar responds. But effectively, what you've got is a situation where April, or as I understand, April 15, is when the tax season really kicks off in the US. And that is going to lead to a lot of money being drained out of money markets, ending up in what is called the TGA, the Treasury General Account on the Federal Reserve balance sheet. And that is a sucking of liquidity out of financial markets. Now, this is going on against a backdrop where the Federal Reserve's QT program is sort of gurgling along, sucking liquidity out of the system progressively. You've got the reverse repo tranche, the facility, which basically was a way of getting liquidity back quickly into the markets over the last 12 months, which is pretty much exhausted now. It's currently flatlining and actually from day to day often ticks up. So you can't rely on that anymore. So what you've got, if you look at the math of the Fed balance sheet, it's likely to dip, I think, probably quite noticeably through the month of April. And there's not really very much that the policymakers can do about that. I think that will be a concern. Governor Waller, however, has said that the FOMC is quite nonchalant about bank reserves falling below 3 trillion. They're currently about 3.5. I think that would be a disaster because that's about a 15% drop effectively in Fed liquidity. And that could cause a serious air pocket in markets. Now, for the near term, that's not a great thing, but clearly there's an opportunity for people who want to buy risk assets to get back in again. So
that answers the question we started out with. But and I think you have a global liquidity versus the S&P, and it's if we could put that up, but I'm so interested to hear you say that because as people are talking about in our chat right now, it was an ugly end to the market today. We started off trying to rally. We saw losses across the board for US stocks, pretty steep ones, 1.5, pretty 1.25. All across the board. The VIX was up 14%. It's still super low, but 1637. And you do feel like the markets are getting more difficult. And then, we love to get these different views of the market. And that's why we love to have you on, because people will say, oh, we had a lot of Fed speakers today, which is true, who sounded hawkish, sounded they weren't in a rush to cut rates. And you could look at some economic fundamentals, but it sounds like you're saying the liquidity backdrop is negative as well and a problem. We've got liquidity draining from the system in the very short term.
Correct. This is the challenge, and the question policymakers have got to try and wrestle with is this a risk to the regional banking sector? Now, my view certainly over the last 18 months when we've been upbeat about markets, is to say that what bests the inflation target, in other words, the Fed ostensibly is after a 2% inflation benchmark, but what bests that is stability of the financial system. If you start to see the fixed income markets or the banking system starting to wobble, the Federal Reserve comes in very quickly. What they need to do is to maintain the integrity of the financial system, and that is their major goal. It will override inflation concerns, certainly in the short term. And if there are problems in the regional banks, again, just look back to what happened in March of last year, when that was really, if you like, the starting gun for a lot of liquidity coming back into markets, when you saw the SVB crisis. If that echoes again, we get a follow-on from that. New York Community Bank clearly has been a concern over recent weeks and months. If you get further problems, then I think the monetary authorities are going to come back. I'm sure they're standing on the sidelines waiting. Now,
so we've been thinking and having people on saying that the higher for longer, and that would match up with the Fed messaging. Maybe we're not going to cut. Maybe we're going to leave rates higher. Maybe we get a retest. And I'm curious what you think about what is going to happen with the 10-year. But are you suggesting that also this falling liquidity will further pressure financial banks? So it's not just that they have the interest rates high and you've got money markets competing for the funds, but also that the draining liquidity, the falling liquidity short term for the reasons you just mentioned, is also further pressure that could strain regional banks?
correct. Absolutely. That's the main thing. I mean, I come at this from a liquidity standpoint. So for me, liquidity is by far and away the most important thing. Rates don't matter so much. And I come back to the analogy that, what we're living in is a world of massive debt. There's huge amounts of debt worldwide, 350 trillion. The point about debt, unlike equity, is that debt needs to be refinanced. So you've always got to find the roll. So if you've got a 5-year average maturity with 350 trillion of outstanding debt, the math says you've got to roll 70 trillion every year, and you need balance sheet capacity, in other words, liquidity, to do that. Now, if you think of the simple analogy of a home mortgage, if you need to refinance your home mortgage, it doesn't matter so much what the interest rate is for the roll, it's whether you actually get the roll from a lender. If you don't get the roll, you're homeless. If you're a corporate that wants to roll their debt and you don't get the roll, you default. Now, as it happens, debt's never paid back. It's always rolled. And that's the key thing. So you need liquidity. Liquidity is paramount. And every financial crisis, if you look back over the last 2 decades, has always been a refinancing crisis, and it's hard. And that's what we've got to worry about. Now, interest rates are clearly out there as a factor to think about, but they're much more, in my terms, thinking about the forward guidance that the Fed is issuing to markets. And I think that, if you look at this higher for longer argument, which I certainly buy into, the fact is that the momentum of the US economy is sufficiently strong now, I think, to pretty much rule out rate cuts this year on economic grounds. Whether you'll get them on political grounds is a completely different question. And Jay Powell keeps saying we're at a peak, and he hints we're going to cut. So I suspect that's playing into the election. It's not addressing the economy. The economy looks pretty robust. Look at the latest ISM. All these indicators are pointing upwards. Look at shipping activity. Asia Pacific trade is zooming at the moment. You just got to look at the throughput of Singapore ports, Chinese ports. Look at what's happening to LA, Long Beach. All these things are telling you that Asia Pacific trade is picking up. So the US economy, I think, is on a roll. It's beginning to accelerate. That is not the backdrop for rate cuts.
So it's the economy that he's looking at. It's political, but it also is financial stability, right? That is the other third thing that we've got to watch for. That's going to dictate Fed policy.
Yeah, but the overriding factor, I think, is the financial stability question. Is that what they can't afford to do is to let too much liquidity drain out of the system, because that will pose a problem for the regional banks for sure. We saw it last year. We've seen, we know that the regional banks, many of the smaller ones, are suffering from a lack of liquidity. They haven't got the sufficient liquid assets, and you need to get that into the system. The big banks, JPM, on a roll. They're looking fine. Just look at the share price of JPM. It's doing wonderfully well. But the regional banks are under a cloud.
Is it possible that it doesn't matter if there's financial strain in the regionals? Can they just, I mean, is there, a demarcation line between the too big to fail and then the rest of them? Do they just get eaten up by those that are doing well?
Well, I think the long-term story has got to be yes, because if you look at the US banking industry, it's way too fragmented compared with other regions worldwide. So there needs to be a consolidation. I'm sure the authorities are trying to foster that in the medium term. In the short term, I'm talking about the next few months. I think if there was a regional banking problem, but you tell me, you're more of an expert than me on this. In the US, if there was a regional banking problem, would that feature in the election? I'm sure it would. It wouldn't be the sort of thing Janet would want to oversee.
Yeah. Well, the other issue that we have now is, how regional our regional banking crisis now that everyone has a bank app on their phone. I mean, that is the sort of shot across the bow with SVB that we don't know the answer to. And okay, that maybe was small enough while their creditors ran, everyone else sat tight. But what if it's a bigger one? Or what if it's closer to home? Or what if it's in conjunction with something else? Do you run the risk of a run, even though they are, in terms of their importance of the system, small and something that can be ring fenced? I think this is something the Fed is looking at really hard, and they don't know the answer to that because this is a new world we're living in. So your point is spot on about this, being something that is maybe politically a problem, but also just a problem for the financial sector. So we have so many questions, but I want to make sure we get through medium term because we touched on long term and just thread them all together before we answer what are some really good questions here. So we've got this short term, sounds like, problem or rough spot. Global liquidity is being drained. We've got that could be pressure on markets. What happens medium term? And we talked about the US and some of the factors. What about China here? What about the rest of the world in terms of liquidity? Do you expect it to then turn back up, or is that unclear or murky in the medium term?
No, I think it's pretty clear. I think what we're in is a liquidity cycle that's expanding. We called the bottom on that cycle in October of 2022, just after the British gilt crisis. It was reinforced by the SVB failure. More liquidity came in, but that was pretty much the bottom. And if this is a normal cycle, which I think in many ways it is, what we're likely to see is a peak in that cycle around late 2025. So we've got a lot of months to go yet in terms of the cycle. Now, one of the things we've been expressing in our research notes is that look at how markets respond to that, particularly take the S&P, and what you see in a normal bull market for the S&P at this stage of the cycle, after about 15, 16 months of a bull market, you've already seen 2/3 of the ultimate gains in the bull market. So in other words, there may be a third to go. Now, a third's may be worth having, but you've got to remember out there's been an awful lot of bears that have missed the first bit. So there may be, there's going to be disappointment. But the fact is that the risk return balance in the market is changing. That's clear. It's going to be tougher in the next 15 months to make money, but you'll still make money. So I think that any air pocket is worth exploiting. And if there's an air pocket in Q2, which forces the market lower, buy back into it, because everything seems to be falling in place now for a normal investment cycle. Look at the performance of sectors in the US market. It's absolutely been true to form. Technology has led. Cyclicals are outperforming. What we're starting to see now is, or we should be seeing, is performance coming out of commodities, tick that box, out of energy stocks, and out of banks, particularly the big banks. And all those things seem to be moving. So it looks like a very normal cycle. Also, what economists have been derailed by is the inverted yield curve. But my argument is that the inverted yield curve is, if you like, a phony figure, because what's happened is the 10-year yield has been depressed by this huge amount of bill issuance that's been put through by the Treasury over recent quarters in terms of their funding regime. So that's actually artificially depressed the yield curve. If you do an adjustment to the yield curve to make good that anomaly, what you find is the yield curve never inverted. In fact, the true yield curve never inverted, and it's actually been steepening since February of last year. Now, if you say that the yield curve is normally a 1 year ahead lead indicator, that concurs exactly with the upturn in the economy we're currently seeing. So everything, to my mind, is fitting into place. And the only thing that I would say looks different is that bond markets were a little bit stronger last year than I would have thought. But I think that's because of the scarcity argument, because there's been so much bill issuance that people were forced into the coupon end of the market because there weren't many available.
Yeah.
Now that's being addressed. Yields are going up.
So, do you think they could get to 5.5? Does that seem reasonable based on what we're seeing?
Well, I think 5.5 may be pushing it. I think our targets for a long time been 5.25. In other words, that they're going to pretty much match what the short end is currently. The problem that you've got, the reason that yields are being forced up is really because bond yields have two moving parts. One is rate expectations. As I've said, if you look at the momentum of the US economy, we do a nowcasting on a daily basis of what the momentum is in US economic growth. That points to an acceleration of the economy. And if you look at market expectations for what terminal Fed funds rates are, what you can see is that normally matches that GDP nowcast. In other words, they move pretty much in step, but there's been a noticeable divergence. In other words, terminal policy rates look too depressed relative to the strength of the economy. In other words, economically, you've got to rule out rate cuts. Politically, as I say, that may be a different question, but economically, the Fed should not be cutting at the moment. Now, that's point number one. Point number two is the term premium. That's a wonkish concept, but that's your, if you like, cushion for taking on interest rate risk over the term of the bond. And what that's affected by significantly is the amount of new issuance that's coming into the market. If there's a lot of new issuance coming on, you'd expect that term premium to be positive. And looking out on the calendar, there's a lot of issuance coming. The Treasury have switched back away from bill finance towards more coupon issuance. And that's got to be pushing coupon yields up. We're starting from a place where, in Ireland, they have the saying that if you want to travel to Dublin, let's not start from here. And this is pretty much the case with the bond market. You don't want to start with a term premium that's currently negative, because we know historically it mean reverts. And there's a lot of upward pressure, I think, on yields coming through.
I love that. I'm still, by the way, you got to find the roll, the idea that you're always rolling over that debt, and you've got to find and that is such I think, great explanation why liquidity matters so much for those who are wondering why everyone's so keen to track it and so keen to chase after you for your thoughts. So
we didn't talk about China, by the way, but you did ask me that question.
We did. So I want to get to that. I just want to wrap this up about this medium term. Ralph is saying, so what, in other words, he's saying buy the dip, but I just want to be clear on this, because you're also saying that the easy gain in assets is gone. You might have an opportunity to buy the dip, but it sounds like you're couching that a little bit. What's the determination? Do you just have to be nimble and watch for the turn? Does it matter how strong the economy is and the Fed response? How do you square those two things?
I think that's a key point. I mean, strong economies don't have strong financial markets. That's a fact. So if you're looking at a very rapid acceleration in the US economy, then I think you've got to rule out big market gains. What we'd like to see, the best environment for any investor, is a tepid economy that the Fed is trying to get going. And if we've got that situation, then you're going to make a lot of money out of financial markets. I'm not sure we've got that right now. I think we've got an economy that is accelerating, and a Federal Reserve that may want to ease, maybe it shouldn't. So I think we're in that sort of halfway house where you can make decent gains, but nothing like we've seen in the last 18 months. Those were the easy gains, where there's a lot of skepticism, but liquidity was definitely coming into the markets.
Right. I think that's a really important distinction to make, so everyone was clear on your thoughts on that. So Peter asking, what's going to be the biggest driver of liquidity for this year's cycle, and where is this coming from? So this is, I think, a good point to get into China. So you can answer that question, but how is China factoring into this?
Yeah. Okay. Well, let me let's address China, but let me sort of caveat that by saying if you look at liquidity or global liquidity, basically we think that it broadly has two big moving parts. One is what the central banks are doing. In other words, what the Fed is injecting, or the BOJ, or the People's Bank of China. These factors are clearly important. The other is basically how much collateral can be levered up. In other words, what we think of as the collateral multiplier, which is really what the private sector does. Now, what that is conditioned by, to a very large extent, is bond market volatility. So if you've got bonds which are highly volatile, then you've got a situation where the collateral multiplier will shrink and liquidity will be dented. So you don't want misbehaving bond markets. Now, to go back to something which is a key metric, which is the MOVE index, which we've been long saying is a much more important metric for equity investors than the VIX. So the MOVE is the equivalent, it's bond volatility across the curve. And when I was, more involved in bond markets, it used to be the case that 150 on the MOVE index, it's currently under 100 for reference, but 150 was end of the world thing. That's when the Treasury or the Fed lost control of the bond markets. It was when you switched the lights out. Okay, we got up to 200 in March of last year. Okay, a year ago. So that was how bad the situation was. The MOVE has come down a lot since, and that's certainly helped global liquidity pick up. If you get bond volatility, that's clearly a negative. I suspect we're going to be seeing bond volatility remaining around these levels, in my view, because I think the yields are going up, but I don't think it's a fast move. So from that perspective, it's a good thing. So that really comes back then to the central banks. What are the central banks doing? Well, we've mentioned the Fed. The Fed, I think, wants to ease. I think the basic backdrop is that financial stability is paramount, and they'll want liquidity to go in to the markets through this year. There may be an air pocket in Q2, but we can look through that. And then longer term, the fact is that the Fed balance sheet has to expand, or if you like, directly or indirectly. The indirectly may be via the banks themselves. So what you're actually getting is a situation where there's monetization of government debt, and that is effectively a boost to liquidity. Just look closely at how the Treasury or the Fed are trying to change the rules on bank liquidity requirements. Whether they do it hand in hand with Basel or whether they do it by themselves, watch that space, because it's coming. And that will mean that the banks themselves are able to buy a lot more bonds, Treasury bonds, and effectively bail the government out. But that is monetization. Make no mistake about that. So the Fed is on a course, in my view, for more liquidity. BOJ is definitely going down that path of more liquidity. Don't read anything into these rate increases. They're cosmetic. They're not about the BOJ about to tighten. Everybody has been calling the yen stronger this year. We've been very negative on the yen, fortunately, because it certainly has not behaved. And I still think the yen is part of let's call it a stalking horse to try and push the Chinese yuan lower. Now, that may be a maverick view, but it's played out so far. And I think this is all about capital wars and about trying to get the dollar dominant in the world financial system, or at least to preserve that. And what the US does not want is any sense of a strong yuan, or a yuan that people may use as an international standard of value. So basically, what you want is the yuan to weaken. Now, I think they're pushing the Chinese economy in a direction whereby that will happen. My view has been that the yuan is going to devalue to 8 against the US dollar. That's a long-term view, but I say a long-term view, it's a long-held view. I think it could be here in the next 18 months. But the backdrop will be that China expands liquidity to get there. And the parlous state of the Chinese economy means that the only thing they can really do now is to get the People's Bank to pump more liquidity into the system. They did that hugely from June until early March of this year. There was a lot of liquidity went into Chinese markets, courtesy of the PBOC. The Lunar New Year is a difficult period to read because Chinese financial markets are normally very liquid then. China is a very seasonal, or the money markets are very seasonal. Being an agricultural economy, this time of year tends to be a lot of abundant liquidity in the system. And what we're seeing now is evidence in the last few days that the People's Bank is coming back and adding liquidity. And I suspect that what that will do will push the yuan lower over time and allow them to ease policy. So I think all these central banks are basically in the game now of trying to support, lackluster economies.
Yeah.
And if that's happening, watch the ECB because they need to do it big time.
And I want to ask a follow up on that. But Nick C and Sean, I think that both answered your questions. Nick was asking, is there any way the Treasury can increase liquidity and affect a specific part of the curve over the Fed's actions? And Sean was asking about Basel III. And I think you both touched on those when you were talking about the Fed. Sean also said, "P.S. Your book is great."
Thank you.
Just to mop that up, Angela asked a slightly different version of it. Do you think the Fed will remove the SLR from banks and do stealth QE in that way? I guess you could also say, with all of the measures you talked about, could they find all these other ways to be injecting liquidity into the system without actually easing if the inflation backdrop is problematic for them and they're thinking about credibility issues?
Yes, I think they will. I think that there will be changes in the SLR. I think there'll be changes in Basel agreements. I think my view is there'll be a Basel IV that will be coming, and that will ease constraints on banks. At the end of the day, what you need, I mean, let's be explicit here. We're in a war economy. Okay, war economies are inflationary, and they need wartime finance. And what happens if you look back at past wars is that banks have taken up large amounts of government debt, whichever the country you're talking about, whether it's the US or whether it's Europe. This has happened. This is the way they do it. And when I say we're in a war, maybe we're in a war, a Cold War against China, but we're also in a war against demographics. And that's the key challenge out there. Aging societies are causing treasuries, huge problems. And that's the reality. As I said, Medicare, Social Security, they're draining the treasury. And governments have got to be less generous, but they can't be. These are mandatory requirements.
I love that thinking about the concept that way because it's an important one. We talk about demographics a lot when we talk about the coming retirement crisis, but the idea that the spending we're seeing, which people, I think are always have sort of slightly different ideas about where all that money's going, but demographics really sums it up, and all those entitlements to try to provide for people. The math doesn't work anymore. Very important question. Two of them I want to squeeze in. Bitcoin. Wait, we have so many questions. I'm trying to find out who asked this. So Ralph asked, is liquidity backdrop. So given the liquidity backdrop, are you getting long crypto or other high beta players? I'm going to take out the high beta players for a minute, but we talked in the long term about this sort of devaluation that's happening and people having to adjust their portfolio for monetary inflation, Michael. So how do Bitcoin and maybe traditional gold play into that?
Okay, well, I think these are really great questions. There was a tweet I did, I think earlier on today, which actually Raoul answered with a very insightful comment, which was basically looking at the ratio between financial assets and global liquidity. And the point of the chart was to say that actually what you've had is more or less a flatlining of that ratio over the last decade. And basically what's going on here is that global liquidity is going up, financial assets are going up, but they're more or less sort of treading water together. And there's actually, if you look at the chart closely enough, there may even be a slight decline saying that financial assets are not actually matching the rise in global liquidity. Now, global liquidity expansion is monetary inflation in my terms, and therefore what you need are dedicated monetary inflation hedges. And those dedicated monetary inflation hedges are gold, and we suspect, and I use the word suspect, cryptocurrencies. We don't know because the timeline or the history is too short, but certainly that's how they behave. Bitcoin behaves like exponential gold. And if you look at the multiplier or the loading, every 10% rise in global liquidity leads to about a 12 to 15% increase in gold. The loading for Bitcoin on average in its history has been 5 times. So it's 5 times the loading of gold. Now, that will likely come down, but you get my point. It's highly sensitive to liquidity. So if you get an air pocket in markets because of liquidity, Bitcoin may suffer. But this could be a great opportunity to buy into it again for another rally. Because if I'm correct, and there's all this money printing out there, these are the great hedges to own.
Great stuff. And we should end by talking about the US dollar in that case. And Adam asking, central banks abroad seem to be ahead of the US in terms of easing policy. trying to juice their economies. Is this an opportunity for international investing, or will the U.S. dollar dominance be a wet blanket?
Well, I think the fact is that on all our models, the dollar looks to be firm. That's for sure. The reason for that is basically twofold. One is, as I think it was Adam you said mentioned, that the Fed is lagging other central banks, so that's one factor. The Fed may catch up, who knows? But the reality is that what you've got there is a very strong U.S. economy. The other factor that's driving the dollar is that economic strength, and cash flow generation coming out of the U.S. corporate sector is really starting to accelerate now. And that's one of the factors that we look at closely when we assess the dollar. And that is besting what's happening in the rest of the world. The rest of the world is not performing anything like the US corporate sector at the moment. So what you've got is two big ingredients that are favoring the dollar. Now, that's the backdrop. I think the dollar is, as a paper unit, will be at least firm. It will outperform other currencies. So the DXY, the Dixie, is likely to move up over time. But the dollar will still probably fall against gold, and it will fall against Bitcoin. So those are much better monetary hedges. Now, one of the things that's worth thinking about is to go back to where we started, which is the air pocket in markets because of liquidity, or liquidity drop because of tax receipts going into the Treasury. If you get that air pocket, one of the ways that the Treasury have gotten out of that in the past is to talk the dollar down through open mouth operations. In other words, they jawbone the dollar lower. And if you start to see problems with liquidity, don't dismiss the fact that there could be a temporary jawboning of the dollar. And that's something to watch for. It would tell us a lot about how concerned officials are about liquidity. And I suspect if they do that, that would make me even more bullish for the medium term, because therefore, that liquidity or the lack of liquidity is a problem for them.
That's so interesting. And where would we listen for that? There was back in the day, we used to chase people around all the time because there was always verbal intervention. There was actual intervention in the Forex markets. I remember dogging some of those officials, but where would we see that drop now, Michael, you think?
Well, I think I would listen to speeches by Janet or by Fed officials to see what they're saying, but also just watch the dollar. That's the real marker. If the dollar starts to weaken in the Forex markets, then you're going to start, then there may be some heads up that this policy is underway.
Yeah, watch that closely. That's a fantastic tip. It's not a market everybody watches in the way they used to. Everyone's kind of glued to stocks because that's what's in everyone's portfolio, but a really, really good indicator for us to keep our eye on. I'm going to sum it up with Paul's words. Howell's on fire today. He can't be stumped. I feel like that's always the case. And we're so fortunate when he comes on the platform, and he was nice enough to come on the Daily Briefing today. Michael, my head is exploding with all the fantastic information that you just gave us. So thank you very much. We're all a lot smarter.
Thank you, Maggie.
Great stuff. We'll go revisit this. Think on it, rewatch it, everybody. It'll be on the platform immediately. And I know you're going to have questions, so you can roll up with them. Again, we'll try to do our best. But great stuff, Michael. Thank you so much. Have a great weekend.
Great. Thanks, Maggie. Enjoy.
Thanks, everybody. Bye. Take care and good luck out there.
Kraken Pro is the powerful crypto platform for experienced traders who demand the best. With advanced charts, real-time market analytics, and lightning-fast trade execution, Kraken Pro empowers you to trade your way. Customize your setup and make every pixel count by rearranging and stacking trading modules in a way that makes sense to you. On Kraken Pro, you have the freedom to put your favorite market analytics and execution tools exactly where you need them. And whether you're a seasoned pro or just starting out, Kraken Pro has everything you need to navigate over 210 plus assets with confidence. Join the thousands of seasoned traders who trust Kraken Pro. Visit realvision.com/Kraken Pro.